can move on now to the next session. So the next session is going to be on alternative investments, and is going to be chaired by Mr. Theofanis Mylonas, CEO of the Eurobank Asset Management Company. Fanis is holding various positions in various board of directors. He's president of the Group Investment Strategy Committee at Eurobank, and he's also chairman of the board of directors of Eurobank Fund Management Company in Luxembourg. In the past, he has acted as a president of the Hellenic Fund and Asset Management Association, and he has a rich working experience working also for Citibank and Schroeder, Salmon Smith Barney. Fanis, thank you very much for being with us. The floor now is yours.
George, thank you very much for the invitation. It's always a pleasure to be here. And I don't know how long ago this was planned for, but it's for sure very, very accurately timed, because what we're going to discuss, I think, especially in Greece now, is of imperative importance, especially after the changes we had in law, as the minister just mentioned. It's a topic that it's on everyday investment decisions now. And just a small example, I just came from a meeting discussing about the asset allocation, what's the percentage of the alternatives, how we populate the products we have on the alternatives, and so on and so forth. So it's quite important. And one more small note is that, on the other hand, on the other side, we have investors all the time coming up and asking us, how do we apply a policy? How do we invest in this? How we can explore this space? So, and also about regulation. So these are all the topics I'm going to discuss. So without no further ado, I would like to introduce the first of our speakers today, which is Rob Martin. I would also like to say that because we are not taking into account any gender, but because of manners, traditional manners, I would like to say I'm sorry to Luba for being second, but nevertheless, we are gender agnostic. So I would like to introduce Rob Martin. Rob Martin is the global head of investment strategy and research at LGIM. He leads the formation of market and thematic views, and he takes an emphasis on long-term drivers, including ESG, which is quite important in my view, and supporting all this integration to the portfolio strategy. He also looks into the performance assessment of these assets, the real assets, which is something that is also very, very important and is going to concern us all in these decisions. And Rob has a long-standing career in LGIM from 2006. And before that, he was working for Hammerson PLC as the head of research. So, Rob, the floor is yours. I'm very interested, and I'm sure that the rest are very interested to hear about the case of real estate and private credit and how we can treat all this in our investment decisions. Rob, the floor is yours.
Fanis, thank you very much indeed, and good afternoon, everyone. I'm really looking forward to talking to you today about private markets. I'm going to start with what I'm not going to say. I'm not going to talk about where valuations are today. I'm not going to talk about short-term tactical opportunities. I think, you know, it's in my bio. Fanis has set it up. We focus very much more on the long term, and I think that's really where I want to direct my comments today. Obviously, the theme of the conference is around DC, and I think there's some particular messages that are very interesting from a DC perspective and how private markets plays into that. So that's really where I'm going to focus my comments. I have a few visuals that I will use. So we're a little out of practice with Zoom. This does take me back to the old days, but we're more on Teams now. But let's see if this works. We will go to the window. We'll go to here and present. So I am hoping that people are seeing some slides up on screen. I'm sure people will let me know if they're not. So the title of my talk is Private Solutions, the Case of Real Estate and Private Credit. I think as I'm first up talking about private markets, it would probably help us to orient ourselves, because I know we've got a very general, broad audience here. This is how we think about the private asset classes. We are obviously talking about private markets, unlisted assets. This is the way that we segment the universe. Private equity has obviously been the mainstay of the private markets for many decades now, and there's a rich variety of investments that can be found in that space. As it happens, my business doesn't participate very heavily in the private equity markets. My business is much more involved in real estate, infrastructure, and private credit. I suspect that real estate and infrastructure are familiar to many of you, and they are clearly very large parts of the private credit and private markets universe. Private credit is an area that has grown exponentially in investors' minds over the last decade or so. One of the things that I will go on to say is that private credit is actually a very diverse space, a very interesting space, but a very diverse one. And I'll spell a little bit of that out in a few minutes. The last area to mention here, and I just want to tease you with this one because we don't really have the time to go into it, but natural capital and resources in a world of decarbonization, in a world of new rare metals that the decarbonization effort will focus on, we think that this area is incredibly important for investors to be starting to think about now, but definitely over the next 10, 15, 20 years. So I would really advise you to start thinking about that area, even if we don't have too much time to spend on it today. So why are we talking about private markets? This is a fairly conventional risk and return scatter plot. The blue dots here are a range of public asset classes, different geographies, equity and credit, and looking at where they plot on the risk and return spectrum. And the two red dots here are a diversified portfolio of private market investments. I know many of you will already have been thinking about the topic that I'm about to mention. In private markets, we rely on appraisals to report valuations. Those appraisals are often relatively smooth in terms of how they move from quarter to quarter. NAV means net asset value, the reported valuations that you receive from your managers. That is often a smoothed version of reality. When we're modeling the private markets, we de-smooth those returns and turn them into public market equivalents. And that's the red dot over towards the right-hand side. And that clearly increases the expected volatility of private market investments. But even after you de-smooth the return to private markets, we think there's still a really strong case for including private market investments in wider investment portfolios. And when you also include the diversification benefits, you get an additional benefit to risk-adjusted returns. So the case for including private markets in portfolios is, in our view, really strong. But there is, and that is something that's true for any investor, any institutional investor, there's a particularly interesting angle for defined contribution investors, and that is around member engagement. And I'll go on to say what I mean by that. Certainly, this may well be the case in the Greek system, but this is definitely the case in the UK system where my own business operates. There is a real issue in the defined contribution space around engagement, and the fact that many savers, many DC savers, are very unengaged, very uninterested in their pensions. And we think that's a real problem. And we think that private markets have a really interesting role to play in promoting better member engagement in their pensions. What I'm showing you on the slide here is the results from a survey that we ran back last year. And what we were trying to gauge was how interested were DC savers in the idea of private investments, and particularly investments where there could be a tangible benefit to their own communities. You could argue the language we used here was a little bit leading. So we talked about renewable energy infrastructure, we talked about affordable homes, and we talked about better roads. But what we found is that DC savers were pretty engaged in those ideas. And I think in a space where often savers are not very engaged, this is quite an interesting angle for private investments. And there is, I think, a real value in having stories to tell that actually can help to promote engagement. It might help to tell you one of those stories to give you a handle on what I mean. This is a slide that I took from one of our investor packs actually recently. This is one of our pension funds. As it happens, many of the investors in this pension fund are DC savers here in the UK. This is an example of an initiative that we were able to talk about in one of our strategies. This is the refurbishment of an office building in Maidenhead. That's a small to medium-sized town west of London. It's a business district, and this is a refurbishment project that we undertook over the past several years during, I have to say, a very difficult time in the property market. But what we did with this capital project is strip the entire building back and completely renovating it. And part of that was to introduce a whole range of ESG measures to reduce energy consumption, to replace fossil fuel boilers with electric points, and also to undertake a number of social impact initiatives. This is the kind of building that a lot of our DC savers are going to be working within. And we think these kind of case studies, these kind of vignettes can be really powerful in engaging DC savers. Now, this isn't just about private markets. I think that's really interesting for engaging savers in their pensions more generally. And in particular, if it encourages them to save more, that's a really positive outcome. But to achieve those outcomes, it's really important to embrace structural change and be forward-looking. There is a perception, and it's an understandable perception, that the private markets are relatively slow-moving. And I showed you a chart that shows you that that's the way that we report it. But I have to tell you that mega trends are absolutely reshaping the private asset classes as much as they're reshaping the public asset classes. Let me give you an example to demonstrate what I mean there. Phanis kindly ran through my background, and this is actually an example taken from my own experience. So I came into financial services in 2001. Seems like an awfully long time ago now, and I took a role with a listed UK real estate company. It's Hammerson Group PLC, and what I'm showing you on the left-hand side here is their portfolio allocation in 2004, roughly 20 years ago. 20 years ago exactly, actually. And
Rob, sorry for
Yes.
interrupting. For some reason, you have not shared your screen with the slides, and we cannot see them.
Okay, well, let's try that again. Let me see. Give me one moment. Can you see anything now, George?
I'm afraid not. If you
Okay.
click on the share screen on the bottom bar of your screen, there is a share screen green arrow there, and indicates on share screen. That should do it.
That is. How are we doing now?
Yes, now it works. Great, thanks.
Now it works. Okay. Well, hopefully you've been able to cope with my dulcet tones for a couple of minutes. We can of course share the slides after the meeting, so hopefully you won't have missed out on too much of what I was going to say there. But hopefully what you're seeing now is a couple of column charts, and I'll just restate what I was describing a minute or so ago. This is the portfolio allocation for Hammerson Group PLC back in 2004. And at that point, Hammerson had quite an unusual portfolio allocation. It was 70% allocated to UK retail property and 30% allocated to offices. And at the time, that was a very large overweight allocation to retail property. And by that, I'm talking about shops and shopping centres and out-of-town retail parks. It was a market weight exposure when it comes to offices. Now that point, 2004, marked, I have to say, the start of the online e-commerce revolution that we've seen over the past 20 years or so. This hasn't just obviously been a facet of what we've seen in the UK, but it has hit especially hard in the UK. And the share of retail sales going through e-commerce started at around 2% back in 2004. That is now up to about a quarter of all retail sales today. That has had an absolutely dramatic effect on the retail property market. We've seen lower demand for retail property. We've seen higher levels of vacancy, and we've seen a big reduction in the valuations of retail property. They used to occupy around half of most investors' portfolios back in 2004. That's fallen to 20% today. That has had an absolutely dramatic effect on returns. What I'm showing you here is on the dark blue line, that is the total return index for a balanced portfolio of UK real estate from 2004 through to 2022. The compound average return has been 5.5%. For the portfolio allocation of my old firm, Hammerson, that 70-30 retail office has delivered just 2% over that period. If I put it another way, that unusual portfolio allocation, that overweight position in retail, has wiped out about 75% of the return from real estate over that period of time. So it's clearly, even within these asset classes, structural allocations and precisely where we are allocated has a very dramatic effect on returns. So if this has been the challenging area of the market, which has been the more positive area of the market, well, the counterbalance to the weakness in retail property has been a huge expansion in logistics property. And where we've seen a huge amount of expansion is from the likes of Amazon and the other logistics operators who now needs more space to service those e-commerce occupiers. More recently, we've also seen, in the context of COVID and now more recently post-COVID, a lot of interest and desire from a whole range of participants to reinforce their supply chains. So that is leading to a huge amount of demand for industrial property of all kinds. And the allocation in the average investor's portfolio has roughly doubled over the last 10 or 15 years. The other area of expansion, and for us a really critical area, has been in the residential property space. It's been an interesting journey here. If you looked back 100 years, many institutional investors had a huge allocation to residential property because it was seen as a very safe investment. That fell away in the post-war period, so that most of the property that institutional investors were allocated to were occupied by businesses. Well, that is now starting to swing back, and that is a manifestation of the fact that these are needs-based asset classes, and they deliver a high level of occupancy and a very stable income profile. You can see here, this chart is showing you the occupancy level within these types of asset. Office property has suffered very severely post-COVID, but vacancy levels have always been relatively high here. You can see also that retail property vacancy has been trending up, occupancy rates have been trending down. That's a manifestation of the structural changes that we were talking about a minute ago. And we think there's a lot of expansion here in the role of residential real estate in investors' real estate portfolios. We've started with private sector housing, but there's also a role for affordable housing, so social rented. And increasingly, we think that senior housing has a real role to play as well, alongside student accommodation. So there's a huge amount of expansion in allocations that can be made to residential property. And we think that's very important in terms of driving returns over the medium and long term. And we spoke a little bit about private credit as well. And I just want to draw out a couple of the comments that I made there. What I'm showing you here is a very simplistic schematic of the private credit universe. And it's intended to give you a sense of where private credit sits relative to public credit. Towards the top hand right of this schematic is actually where the bulk of private credit investments are located today. It's got relatively high credit risk, but it's also got relatively high returns. This is where leverage loans, this is where direct lending to SMEs, this is where mezzanine finance typically inhabits. And that's actually where most private credit strategies are located at the moment. My own business, Legal & General, actually our heritage is more towards the bottom left. This is the investment grade part of the private credit universe. And the reason that we've historically focused particularly in that space is that we are owned by an insurance company, and many of the assets that they are looking for very high credit quality to sit alongside defined liabilities. And so their tolerance for risk is quite low. We think there's a really interesting space in what we call crossover. This is the low end of BBB, the high end of BB, where there is a little bit more credit risk, but actually the businesses are fundamentally very stable, very solid, but maybe not quite big enough or have a little bit too much leverage to tip over an investment grade. We think it's a really interesting space. The point is not to say that any of these is right or wrong, but it is to say that it is important to recognize the range of risk reward profiles within private credit, and that actually it's really important when thinking about structuring solutions for DC to have the right outcome allied to the right investment. That is about where I plan to stop. I hope I've convinced you that there's a really strong case for including private markets in DC schemes to promote better outcomes, but it does come with a health warning. It is really important not to use the past as a guide to directing allocations within the private markets. These mega trends are absolutely key to the future of private markets, and they need to be embraced when putting portfolios together. Thank you for listening, and I'm going to hand over to Luba at this point.
Rob, thank you very much. It was very interesting. We'll most probably get some questions, I'm sure, about it at the end. So let's continue. Let's continue with Ms. Luba Nikulina. Luba, she's a Chief Strategy Officer in IFM Investors. She has almost 30 years of global investment experience, and she oversees the strategy for IFM Investors. The assets under management are quite impressive, more than $140 billion. And she owns some of the critical infrastructure assets around the world. So also providing service to local communities such as ports, airports, toll roads, water and power utilities. In Luba's team, there are more than 100 professionals globally, and are responsible for the development and execution of the strategy, the shareholder and client engagement, as well as government and public relations. Luba has started her career in private markets in 1996, and she was involved in a number of private equity transactions at the time. So I think she's in a very good position to explain to us what are the criteria to invest in private markets, and how is this process, and how does it tackle all these issues. So Luba, the floor is yours.
Wonderful. Thank you so much, Theofanis. It's a wonderful introduction. And it's a pleasure to be here. So I'm grateful to IFFR for hosting this important panel. And also having listened to Rob, and also just having a rough idea what Ludovic is going to talk about, I think we are actually bringing to this panel quite a bit of the richness, not only by gender, but also by the angles that we bring in the discussion. So the two angles that I'm going to try and draw out in the next 15 minutes are going to be, firstly, and maybe somewhat unexpectedly, is about Australia. For those of you who are not familiar with IFM Investors, we are actually owned by 17 Australian pension funds, And I think it's quite instrumental just to quickly go back and think about how this system has evolved and how we have been created. And then the second angle is, of course, as Theofanis just was describing, we own quite significant infrastructure assets around the world. So it would be amiss of me not to talk more about infrastructure. So this is what I'm going to do. And now, Rob, I can so much relate to Teams versus Zoom. So now I'm going to try and do the same to share my slides and see if it works.
Works perfectly.
Screen sharing, great. Now I need to maximize. How about that? Is it working?
Great.
Perfect. Okay. Now let's go to the other side of the world, to Australia. And think about the alternative investment from an Australian DC perspective. It's actually considered to be one of the most successful defined contribution systems out there. And if you think back to the time of its creation in late 80s, it was actually part of a collective movement facilitated by labor unions in Australia, where they were trying to ensure that their members have decent retirement. And this is how a compulsory superannuation system was created, with mandatory contributions that now account to 11% every year and just about to go to 12%. So the system is growing really fast. It's also profit to member model, where all the motivation and all the focus is on achieving great investment outcomes for retirees and for savers. And just quite coincidentally, as the system was created, there was also a big program in Australia run by the government around the privatization of Australian airports. And then at the time, as the first trustees of your superannuation funds were looking at where they can invest, airports and the rest of infrastructure, ports, toll roads, they looked like a perfect retirement asset. So very strong cash flows, resilience from the downturns, linkages to inflation. But then the capital markets at the time were not really providing a good model for them to channel their money into these assets. And this is part of our history, how IFM was created. They basically got together our owners, 27 at the time, 30 years ago, and basically said, well, we will create a collective vehicle, profit to member, to help us invest in those assets in the way that we like. We like to hold them for a very long time, and we like to have it at a low cost basis. So this is the history there. And if you think about the Australian system right now, they're actually quite comfortable with private markets overall. So it's relatively usual to see the allocation around 30%. And I think Rob mentioned that private equity is the mainstay of private markets. Actually, in Australia, it's the real assets and infrastructure what is mainstay of private markets. And infrastructure is anywhere between 10 to 15% allocation. And they have done pretty well from that. So if I can go to the next slide and talk about the case for infrastructure in private markets, it's definitely, I can understand the comment about the mainstay, because infrastructure hasn't really, outside Australia and maybe Canada, entered the mainstay, the mainstay language and allocations, but it's increasingly emerging as a standalone asset class. And the reasons why I think about all my experience in private markets, where I studied in private equity, the reason why infrastructure looks so interesting at the moment is because what we are experiencing, the world is full of different unexpected shocks, be it geopolitical or economic, or various megatrends that Rob alluded to. The markets are very complex. And also, if we think about our experience with traditional asset classes, and by the way, many DC funds will get a lot of exposure to indexed equities or the 60-40 model. And this really didn't perform good last year. And you realize that you actually get more economic exposure and the risk of drawdown if you run this model. Infrastructure, on the other hand, provides you almost this golden middle. It can provide you the growth in good times that you associate with equities, but then at the same time, it provides the protection as well during the downturns. So just thinking about what makes an optimal infrastructure strategy, I will let you skim through the high quality infrastructure assets. What are the main characteristics to a degree? If you have studied private markets, it's just sort of obvious. But I think what is a bit less obvious is the key characteristics on the left-hand side. What makes a good portfolio of infrastructure assets? If you think about the infrastructure universe, it is still dominated by closed-end funds. And more generally, private markets would often be about closed-end funds. And it's both a blessing and a curse. It obviously creates the sense of urgency for an asset manager to own and exit assets. But if you own a really good asset and you don't want it to be exited as an asset owner, which is often the case with infrastructure, then closed-end model makes less sense. And this is, again, the innovation of our Australian owners, where they introduced almost 30 years ago an open-ended model into the infrastructure space, which allows us to allow for long hold. The importance of intra-portfolio diversification. There are a number of sectors in infrastructure, and those sectors are expanding, and ensuring that you have proper diversification is incredibly important. We, with 30 years of experience, have lived through a number of shocks, be it GFC or more recently pandemic, and this is where diversification, even in a resilient asset class, it kicks in powerfully. So pandemic, airports became vulnerable, but goods still had to be transported. So ports and roads managed to maintain their cash flows. And more importantly, water utility, power utilities. You cannot really imagine our current society, the kind of shock that would force us to switch those essential services. So all of this was functioning under this major shock to portfolios. Asset management services, you cannot really, well, at least I, as a former investment consultant, wouldn't recommend to hold infrastructure in a passive way. It does require asset management, very strong focus. And the reason is all those megatrends that Rob alluded to. We have automation, we have decarbonization. All of this requires these assets to change, and you need to keep an eye on them to ensure that they're changing with the times. Just quickly thinking about the global infrastructure shift. We now, 30 years into our history, we have a global portfolio of assets and also global privilege to have global client base outside Australia. And what I can see is that at the moment, the pension sector is not really investing as much as they could. From 2011, it's 130 billion investment in the infrastructure asset stock, which is close to 40 trillion. And there is definitely demand to invest more in the existing infrastructure and also to build new. So the incentive, and I would probably even say an imperative to invest more, is out there. So the Mansion House Compact in the UK signed recently, trying to encourage pension funds to invest more in private markets. And by the way, most of them would be DC pension funds, is one of those examples. or the regulation in Switzerland which allows second pillar pension funds to list infrastructure as a separate asset class is another example, and we expect the same in Germany. In the US, the massive stimulus from the Inflation Reduction Act just propelled the number of conversations that we have about infrastructure. ESG or not ESG, it doesn't matter. The financial argument for investing in infrastructure in renewable energy is there, and US pension funds are considering increasing allocations to this asset class. Just talking about the Inflation Reduction Act and energy transition there, that's a massive tailwind for the sector. How much capital will be required is anyone's guess, but we are talking about tens, if not hundreds of trillions of dollars that we will need to invest before 2050 to be able to allow our economy to transition. COP last year, at the end of last year, it feels like yesterday, the commitment to triple the amount of money invested in renewable power, and then all these other emerging technologies that will require capital and that present a really interesting opportunity for pension funds who are just considering their journey into infrastructure investing. And just continuing on the topic of sustainability, it's not only about energy, it's also about social considerations. Probably not surprisingly, considering our history associated with labor unions, everything related to social, human rights, labor rights has always been incredibly important for us. But now it's becoming important for everyone, including investor, because any investor in the world, because it is becoming financial. Like, you cannot really invest in the long term and not think about the health of the system that you invest in, be it from the environmental or social perspective. And hence, having those investments that actually they transition to the new energy sources, but they also think about jobs that they're displacing and how they can ensure that communities remain safe and stable is incredibly important. As an active owner in infrastructure, you can have so much more influence than a passive owner in an index fund. And then just to conclude on an optimistic note on this Tuesday afternoon, infrastructure is already a success story in Australia and Canada, and it has performed really well during the times of the macroeconomic uncertainty. And it's gaining momentum right now because of the number of tailwinds that I went through. Opportunities for DC funds are there because there is this societal need to invest more. But it's also, importantly, from a DC fund perspective, it's an opportunity to also change for good with much more focus on sustainability that you can apply being an active owner. So with this, I will conclude, and I look forward to your questions.
Thank you very much, Luba. Thank you very much. It was very interesting. So as to be able to have some time to answer questions, I will go immediately to Professor Ludovic Phalippou. Ludovic is a faculty member at the Oxford University at St. Business School and a fellow at the Queen's College. Over the last 20 years, he has been actively researching the private equity industry, and he had the chance to work directly with a number of large institutional investors, which is also quite impressive. In my view, is that his research has been presented in multiple universities, over 100, as I can read from here. And he has also received several awards, including named as one of the 40 most outstanding business school professors under 40 in the world. So I and all of us have high expectations of hearing the presentation from Ludovic, and I give the floor to Ludovic. Thank you very much.
Thank you very much. So I can only disappoint, but thank you for the introduction. So I was told that I just do 15 minutes and we talk a bit about private equity and private debt, the landscape a bit in private markets. The two previous speakers spoke mostly about real assets. I agree with everything they said. It was very interesting presentations. So here I'm just going to talk about a few facts to trigger some thoughts, and then we can have a debate. All right. So I think on the trends, it's worth spending a couple of minutes here. This is not quite the latest data, but it's not far. You see this massive boom in so-called private market funds. So the previous speakers talked about infrastructure. This is part of it, infrastructure funds, real estate funds, etc. But they are a relatively small part of this growth in AUM of private markets. In the early 2000s, most of the private markets were leveraged buyouts. And something remarkable over the last 2-3 years is that actually venture capital, even though they finance smaller companies, have an AUM that is almost as big as leveraged buyout. So it has been one important mega trend. Another one is this rise of so-called funds of funds, secondary funds, etc., which are things like Hamilton Lane, Stepstone, and the like, which didn't basically exist 10 years ago, and are now half of the size of the entire leveraged buyout industry, for example. So this is another type of player which is new, became extremely big, and not everybody may be aware of. Then you have all the real estate infrastructure that we talked about here, but you can see already that they are much smaller. And then there is the so-called private debt guys, who already here at the time of my graph were relatively big. One could add to it the mezzanine funds and a few other things that would make this private debt maybe nearly $1 trillion. Certainly right now they reached the $1 trillion mark. And they are kind of all the rage at the moment when people are talking about where to invest money. Most of the talks are about private debt. And so I'll say a few things about that. So when people are selling private markets and when they are trying to explain this trend, basically they insist on one thing, which is that private market funds have delivered outstanding returns. So the previous two speakers didn't use this argument. They talked about diversification, sustainability, etc., which are perfectly valid arguments. But most people, consultants and the like, when they would sell private markets, they would talk about outstanding performance. And that's probably why the outstanding performance usually comes from the leveraged buyout and venture capital. So what is it on the performance ground? So this is the database that all the academics are using, and that's the most comprehensive database of private market funds returns. So I'm going to show you here the returns per vintage year. I'm starting in 2006 for a reason I will explain to you later. But you can see that from 2006, this is a so-called PME, and this tells you how much the performance is of all the funds raised in a given year compared to the S&P 500. I'm talking only about US funds, that's also very important. And all private capital funds together, it means that real assets are in there, private debt is in there, all the private capital funds are in there. And what this shows you is that if you pull them all together, you get a one-to-one. And in individual years, it's a bit better on the most recent ones, but again, on aggregate, you are basically one-to-one. So the question is then that is different from what you would usually hear. And the question is then, why is that? So this is what you would usually see or be shown. This is a slide that these guys actually put there by mistake. They didn't really realize that their slide was contradicting what they were arguing in their report. So they say this is like the state pension funds in the US, past 10 years returns by major asset classes. And they separated out, and it's very important, the US stocks and the non-US stocks. And what you see basically, this is like, you can look at the median if you want to. You will see that the US stocks are at 14%, the non-US stocks are at 7%. You can look at the average if you want, so similar number, 14 versus a bit below 8. And it's very close to the benchmark returns. So basically, you can see how US stocks over the last 10 years have 14% return. It's twice as much as non-US stocks. And if you look at private equity, and what is important to remember is that private equity is mostly a US investment. Most of private equity investments are in the US. You see 14% return, 14% return. So the returns of private equity, like what I showed you on the previous slides, are indeed matching those of US public equity. So even on these slides that are from a consultant, there is this evidence, loud and clear, like you would find on about any database. But this consultant, if you are reading their report, they would tell you that private equity was the best performing asset class on earth. This consultant specializes in private equity, and the way they managed to do that is by saying, well, private equity returned 14%, and then they pull together US and non-US stocks and say the return of this is only 9%, and so private equity outperformed by 5%. So you have all kinds of things you can do in private markets to show that the returns are pretty good. And this is one example here. I'm going to show you a couple of others. This is another way to see this evidence, or to see why people may show you different returns. So what happens is that people have basically mostly played with benchmark to show that private equity has good returns. So private equity, roughly speaking, has always returned about 12% on any time period over the last 10, 15, 25 years, which is not a bad performance, but it is 12%. And what people have done is that up until 2006, all investment presentations showed the S&P 500 as a benchmark. And the reason for that is that over that decade in the US, there was a massive size premium. So the very large cap in the US did extremely poorly from 96 to 2009. And you can see that whenever you would take any like value-weighted index, anything that is dominated by large cap in the US, the returns would be around 7% up until 2009. But if you would take any small cap strategies in the US, the return would be around 11%, which would be in line with private equity returns. And after 2009, and the private equity, the large cap US performed as well as the small cap US. And so what consultants and some academics have done is that after 2008, they switched benchmarks and use as a benchmark MSCI World to compare with private equity, rather than staying with the S&P 500 like they had up until 2008 or 2009. So there is this switching of benchmark, and nowadays any investment presentation will show you private equity returns against MSCI World, and MSCI World has underperformed quite a lot of things on earth because the US dollars strengthened over that time period, and listed equity in Europe in particular has done particularly poorly over that time period, mostly because it is dominated by bank stocks and some other industries that didn't do well over that time period, like oil and gas. So again, there are a few more tricks you can do, but if you use pretty sensible benchmarks, you find that private equity returns are in line with public equity returns after all fees, which is not necessarily bad in the past. The returns have been reasonable, and there can be diversification benefits and sustainability exposure, etc., which people may want to have. But this is a bit, that's a fact. What happens, though, is that these returns, even though they are in line with public equity, most of the funds are in the money, and we can calculate this on these public databases. For example, these funds who are, I stopped in 2016, so they're outside of their investment period. The funds raised after 2006 to 2016, it's 70% nearly of the funds that are in the money. So they have an IR above 8%. In reality, it's more than that because some of the US style carried interest, and if you have crossed 8% in the past, you already are in the money. But to keep it simple and conservative, it's at least 69% of the funds that are in the money. And you can calculate how much carry they earned for a performance at an aggregate that's just much public equity. And the answer is it's a massive amount. It's like $500 billion that has been handed in to individuals for good performance that does not compensate for any cost. This is purely like a cash payment to the senior individuals in this profession. And this is why I had written this paper about the billionaire factory to show how private equity has generated so many billionaires, even though on aggregate the performance has been very comparable to what people get on public markets. Something that relates a bit to issues with DC plans, which is one of the themes of today, is that the marketing in private equity has not only been pretty naughty on choosing strategically benchmarks, but has been particularly naughty on choosing a measure of performance, which is not one, which is called internal rates of return. And that is flashed to people quite extensively. And when you are dealing with DC, you are often dealing with retail investors, and showing them a performance metric that they don't understand is quite dangerous. It's in fact prone to lawsuits. And right now in the US, there are a number of lawsuits being prepared on this kind of misleading performance presentations of private equity funds. So this is an example of what you would read in 10K filings by private equity firms. You have a firm like Apollo that says that they have generated 39% gross IRR and 25% net since inception. They started in 1990. So they are saying they basically over a 30 years time period, they have generated 39% return yearly, gross of fees, 25% net. If you play and compound what $1 million at 25% a year does, it would be an extraordinary number. You would get like from 1 million, you would probably get to 1 trillion, something like that. It's a completely unrealistic number. Warren Buffett did a bit below 20% net. So you have like a benchmark in mind. And same for KKR, the same numbers. In fact, in private equity, very often, not in real assets, but like in leveraged buyouts, you would typically see firms telling you that they have done 25%, 30% return net of all fees. And that's because they're using an IR. There is a way to juice up an IR. And so they present this like it is a return. You see here with a KKR writing that they compare an IR to the MSCI World Index, even though these two things are completely incomparable, and then tell you that they have returned more than twice as much every year as public equity. And the other extraordinary thing is that these numbers are always the same. So the properties of an IR are such that the numbers never change. And so you have here the reports from KKR ever since they're reporting to the SEC. And you see that the returns every single year is basically the same number. And I didn't continue this chart, but the latest one in December 2023 was again 25.6%. Same for Apollo, never changes. Net never changes. Yale had the same thing. These numbers never changes. And so there is a bit of a problem here with like this IR being presented to investors who don't necessarily understand that these are not rates of returns and get very excited with the prospects of potentially earning 30% and more. Now, most sophisticated people at the moment actually are not too keen on private equity. There has been a big slowdown on private equity fundraising, and most sophisticated investors are looking more into private debt. And the reason for that is that private debt has lent to private equity, and most of the debt has been floating with a spread of 500 basis points, like the first speaker showed. And then what's happening is then private equity funds have now to pay a massive amount of interest payments to these private debt funds. And so most investors are like, oh, wow, so private equity is in trouble. I better switch to the guys who are making a lot from it, which is then the private debt people. So just to show a bit of numbers back of the envelope, because I think it's quite important, basically the interest payments doubled for private equity held companies. So again, thinking more leveraged buyouts. But you also have infrastructure and the like, who also have had high debt being raised. So when the interest rate, which I name here RF, was around 0%, 500 basis points meant that they pay 5% of interest payments. When the risk-free rate went to 5%, it means that then now the interest payments are 10%. And a typical private equity held companies borrowed about 6 times EBITDA. So same in infrastructure, etc. At 6 times EBITDA, if you pay 10% of interest payments, your interest alone represents 60% of EBITDA. It means that more than half of an EBITDA is to pay not even the debt principal, just to repay the debt, the interest on the debt. So it's an absolutely extraordinary number. And one of the puzzles at the moment is that we do see some bankruptcies of private equity held firms, but not that many. And we suspect that, and we can only suspect, but the reason why this is happening is that there is some like payments in kind, that the private debt funds do not want to have a bankruptcy event, and so they are renegotiating, etc., in order to not get into a bankruptcy event. But at more than half of an EBITDA of interest payments, it's a very dear situation for private equity, and that's why the market right now is pretty cold towards private equity, at least large institutionals, and very warm towards private debt, because they say the private debt guys are doing a killing here, and private equity is suffering. The problem is that the private debt funds that are benefiting so much from this increase in interest rates are the ones that were raised before. The ones that are raising money now, which institutional investors are throwing money at, are very unlikely to be able to lend at 10% plus a year. And there is a lot of money chasing deals. So in a sense, I'm afraid that the train has probably left the station there. So this is a summary of what I just said. I have a book on this. I have lots of resources on my website. I have podcasts, etc. If you're interested in more, I'm going to leave it to that and let people ask some questions. But you can go to my website, and there's tons of resources there if you want.
Ludovic, thank you very much. It was very interesting. We should be concluding this session now, but I would like to take the opportunity to ask just one question, because there are also a few questions, but I'll try to sum it up in one question, because I think it would be my questions anyhow. So if each of the panelists can spend a minute, 2 minutes maximum, in order to help us on the view on the following. When we are talking about alternatives and private markets, how do you tackle the issue of size? So if we're talking about the management of a small mandate, how is this going to be included in its investment strategy? And even more importantly, with your experience, how do you think, and what have you seen until now in concerning liquidity, which is quite important, and how do you tackle this issue? And it's also Greek specific, it's pricing, and pricing the real estate sector. I know I've said a lot, but each of you can spend a couple of minutes in answering this. I can start with Luba now, if that's okay with you.
Sure, absolutely. Yeah, quite a few angles there. And maybe just quickly, as you said, 1 or 2 minutes. The reason we were created as a collective was because our clients at the time were not as big, but they wanted to invest in big assets. And so when they come as a collective, they created a vehicle that allowed them to consolidate and invest in infrastructure at scale. And so this is essentially, at the moment, we have smaller clients, of course, because we have 140 billion that we could diversify across. So similar type of idea, and also whether you want just one asset class, or we covered all sorts of strategy, and there are solutions there that allow you to invest through a multi-asset platform. So that's the scale, but the scale is incredibly important. And then with the valuations, this is why I was talking about the need in active management there, because you cannot invest in private markets passively. And the opportunity is so vast that if you look at it actively, it is the time. There are pockets that are absolutely overpriced and overvalued. There are pockets where there are leverage issues. But this means there are also opportunities for those who can navigate this landscape.
Thank you, Luba. Rob?
Yeah, I'd echo a lot of what Luba's just said. I think, I mean, we've seen this even within real estate, which is just one corner of the private markets universe. You know, we used to have a lot of institutional investors, particularly DB pension plans, who would have their own direct property portfolio. Well, really increasingly, that doesn't make sense. The governance burden, the complexity of that management. Increasingly, we've seen a lot of institutional investors move towards the kind of fund of funds type approaches, the you know, using a blend of specialist funds, and I think that's going to keep going, especially within DC, which is a very fee sensitive space. I think one of the other issues is, you know, particularly we've touched on it. It's about real estate, it's about infrastructure, it's private equity. Creating fully diversified domestic and international portfolios at small scale is really incredibly difficult, we think. So we do think that actually these schemes are going to get larger and larger. Maybe one last comment I will make is about the blending of listed and unlisted, to sort of help with that liquidity angle. There is a facet to private markets, which is the underlying assets are relatively less liquid than the listed markets, and we should never pretend that they're not. But I do think there is scope, and this is certainly something that I know is done in Australia and in other jurisdictions, is using listed and unlisted illiquid asset exposures together to create liquidity. So that's certainly what we think part of the answer is.
Thank you. And Ludovic, please.
I have nothing to add. I think it was a very practical question, and they answered very well.
Excellent, excellent. Thank you very much. I think it was a very intuitive panel. I personally plan to use what we've said, what has been discussed here, and also take it offline and try to follow and go deeper in what we discussed. So thank you very much, and I'll pass the floor to the next panel. Thank you very much again.
Thank you.
Thank you, Phanis, and many thanks to all three speakers for this very stimulating session.